What are your expectations this week? I've got to believe, just knowing how you've been, speaking over the last many months and how you've been urging people to be positioned, that you've got to be somewhat surprised that volatility in the bond market has subsided to the degree it has.
Yeah, spot on, Scott. Definitely, I think fixed income volatility did rise over the course of 22, but it didn't move as much as expected at the end of last quarter and into this year. So vol on the fixed income side is down, which is really surprising me, especially because the Fed continues to hike policy rates. But what about the balance sheet roll-off? What about quantitative tightening? We had, so many years of QE and bond buying. You think going the other way would actually be vol increasing. So I think it's a good opportunity for investors to really reset and look at where they own mortgages in their portfolio, where they have short volatility exposure on the bond side of the portfolio, because the Fed, a third of their holdings are mortgages on the QE purchases, which is the SOMA purchases.
So what are your expectations? You did not, by the way, vote in Steve's Fed survey, which was one of the questions I asked our producers because I wanted your perspective on that. Where would you come down on the idea of holding or cutting rates in calendar year 23 for the Fed? What are your expectations?
I mean, I do think the market has priced in about 57 basis points of hikes in the first half of this year, including, the market's expecting 25 this week, and then another, 25. And then the market is priced in cuts. I'm not sure if that's accurate or not. I do think the Fed needs to be more cautious about using other tools besides just killing and hiking policy rates over and over again. I think the balance sheet is a really important piece. And a lot of investors don't realize that in the 8 weeks following the start of the pandemic in March 2020, the Fed expanded their balance sheet more in that 8-week period than they did in the prior 9 years of quantitative easing. So it's a huge balance sheet expansion. And I just don't understand why Powell and the other FOMC members are not doing more there with the balance sheet.
Why don't you answer that, Steve?
I mean, the Fed thinks of the balance sheet like kind of like Godzilla in a cage. They don't know what kind of effect would happen if they let it out of the cage. So they want to keep it in the cage, which means they're going to do these regular roll-offs. The issue with the balance sheet is one of those stories where it doesn't hurt you until maybe it does. There's a consideration that there's this froth at the top, and it may be as much as $2 trillion, that the getting rid of which would have almost no effect on the market until you dig down and you hit some bone, essentially. I'm on like an 8th metaphor in this, aren't I, here? Started with Godzilla, now I'm cutting bones. Anyway, until you get to a point where what they call the binding level, where you've all of a sudden created liquidity issues in the market. In our survey, Scott, liquidity concerns and systemic risk concerns went down, which I thought was fascinating. People are less worried. Remember we had all those liquidity issues earlier? Yeah. They're kind of gone now.
No, but I think, Nancy, you were in the camp of expecting, if not a credit crisis, which I don't think you were, I just think like a more messy situation than we've gotten. Do you think
it's also been for the Fed? It's been unusually quiet. They're kind of surprised too.
Do you think that we're beyond that at this point, or is that still to come as the Fed tries to work through all of this in the face of what appears to be a slowing economy in parts of the economy and then strength elsewhere?